Hi traders, welcome to Admiral Markets. Thanks for joining us. Sorry for that small delay there. We'll be focusing and talking about fiscal and monetary policy, a little bit of a fundamental analysis today and how that could impact Forex market and also just general markets, financial markets, that is, of course. But before we do that and take a look at this topic, Nana and I, both of us, be aware of these two disclaimers. First of all, the webinar is shown to a global audience, but may not be suitable for everyone necessarily. Please, therefore, check Admiral Markets or visit admiralmarketsglobal.com. Select your country of residence and contact the appropriate entity to find out if it is suitable for you. Also, please note that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, so I'll kick off with some fundamental analysis and some indications how you can basically get more information about the direction of currencies when doing fundamental analysis. And then it will add his part in the second part, and we'll take a look also at charts and add his, of course, his view on fundamental analysis as well. You know that we are bigger bigger fonder and use technical analysis more often, as you probably know. It's not to say though that fundamental analysis specifically for the long term isn't useful. When you're analyzing weekly, monthly charts, this is basically very useful info to get the idea about what kind of direction you might get, and then the technicals should confirm that direction. And of course, I don't personally think that the 1 minute chart is influenced by these kind of big things. Um, Obviously, news could, technicals could, wave analysis could, in my view, does. Whether the interest rate of the US goes up 6 months from now by a quarter percent, maybe, is not necessarily going to influence this current, precisely now, this minute. So I think it is more useful for longer term views, of course. That's at least our view. So how do you do that? How do you analyze it? You got a lot of data, of course, coming out each week and being released by multiple countries, and that's basically kind of giving a confirmation to analysts in the market whether their analysis is indeed on track. Is the data, is the vision they have for this currency block or this country indeed on track or not? Or does the data diverge in some way, and how would that impact their vision for that? So the currency does move according to those data points, but it's just like a correction, along the way of a longer roadmap for that currency. You can look at the euro dollar, and you can see how the euro dollar was moving up from 2000 to 2000 or 2001 to 2008, then was moving down, during the financial Great Recession, and then moved up again 2011, then moved down again with the quantitative easing. Euro dollar was moving up. When quantitative easing stopped, euro dollar was moving down. And that's because quantitative easing, the basically printing of more US dollars, is not good for the US dollar. So that did impact the euro dollar, and it went up again. So these things do definitely have impact, and they kind of move the currencies in bigger trends, in bigger directions. And then, of course, from a day-to-day point of view, we would see price move up and down within those bigger moves up. But technically, then we would be, having trading maybe multiple things within that big upside. We could even be trading smaller retracements down, and so. But it's always good to still have in mind that the picture is up at that moment, just to get the long-term view. So it's always good to be aware of that. Now, the currency value is mostly impacted basically by central banks and governments, because ultimately the currency value uh, is rooted in the fact that why would a currency be interested, or why would there be a demand for a particular currency? Well, of course, there's the traditional export and import. So if you have a lot of exports, there could be a lot of demand for your currency, of course. And if you have a lot of imports, you would be selling a lot of your own currency to buy the goods, right? So that's classical impact. Nowadays, we see also, of course, a lot of central bank intervention, maybe more so than before the Great Recession. So today's webinar is more focused on monetary policy, fiscal, and tax policy, not so much on trade policy. So trade is an impact, but we won't focus on that too much. So basically, with regard to fiscal and monetary policy, the central banks are influencing the monetary policy, and the government is focusing on the fiscal and tax policy. And for a currency to lose value or gain value, it depends on what the decisions are made by the central banks and government. There are things or trends that make a currency more desirable and things that make a currency less desirable. So, from a monetary policy point of view, interest rate, of course, is a very known tool for central banks to steer the monetary policy in the economy into a certain direction. So if you have an interest rate hike, that's to cool down the economy, and that means that the economy is doing well. That means the economy and the GDP are growing. That means there's more prospect of further interest rate growth. Perhaps interest rate is growing maybe at this moment or recently. So that is positive for the currency. All right, there would be more demand for that currency. That's a good trend for that currency. It's an uptrend. If the money supply, however, is loosened, there's more creation of this particular currency, that is a weakening for the currency. Because if you have, let's say, very simply, you have $100 floating around as the total money supply. Of course, there's way more, but just to make things simple. And then you say, okay, listen, folks, as a central bank, we decided to add $10 more to that total. So now there's $110 available. Those $100 are not worth what they used to be, right? When there are 110 around, that $1 you might have is worth less. So that dampens demand for the currency or weakens it, makes it less attractive. The central bank is typically looking at inflation targets of, probably noticed, 2%, right? Typically low unemployment. And low unemployment is not something that all central banks aim for. It is something the Fed, this US central bank, does keep in mind, or it's their official target, I should say. But the European Central Bank does not have that. It is also one of the criticisms that some people have of the European Central Bank, that they don't look at unemployment rate and only at inflation. The government's fiscal and tax policy, of course, is also crucial because ultimately it's all about cash flow. To what you get from your citizens, or from natural resources, or from basically just the government budget, however that is composed or generated. And you have your costs, like any household, like any of us has our own budget, income, expenditures. Countries and governments are no different. And then there's a deficit, current deficit, this year's deficit, and of course the deficits of the past. Perhaps maybe some countries have a surplus. There are not that many of them. A rare few do have that. Most have deficits, right? Depends how much deficit and how much does this year add to that deficit. So big deficit is not so good. Small deficit is good. It's popular for the currency demand because basically there's more faith that that small deficit will be paid back. If the debt is very big, eventually investors in the markets we'll start to wonder, will that be repaid? And that seems less interesting. All right, so here you can see these are the equations that you want to keep in mind. What is the budget deficit? And also, basically, what is the GDP debt ratio? So you might have a relatively big deficit, but if your GDP is big, that percentage is not that bad. That's really what it's all about. It's the relative size. Tax policies will also influence a lot of things like investment from private business, infrastructure projects could stimulate the economy, of course, when the economy is a bit in a dip. Basically, could spur consumption or dampen consumption. So these have real impact on GDP growth, and of course, GDP growth is and unemployment, employment, and consumption all fuel GDP, which in turn could lead to inflation, which in turn could lead to higher interest rates. So that's why when these things are going well, there's also more demand for the currency. So typically, central banks are looking for basically avoiding deflation because that is a self-fulfilling kind of spiral downwards often, because then people wait with investing or wait with consumption because prices are going lower anyhow. So it's kind of difficult to fight yourself out of that. Higher inflation is not good because you get a out of control kind of price stability, and there's no stability for companies to invest. So that's what they basically want to get is the central banks into a stable kind of inflation, slow kind of inflation of 2% perhaps, 3% are probably the borders there. And if it's lower or higher, they want to act in a way that they combat that by using monetary policy goals, methods, for instance, increasing interest rate or quantitative easing, right? Increasing interest rates to slow down the economy and decrease interest rates to spur the economy. So there are some tipping points, and typically a country and a central bank want to avoid those because that's when things might become a little bit difficult to handle. As I said, if you get into deflation territory or high inflation territory, or if you have a very high deficit versus GDP, there are certain tipping points where it's almost like it's difficult to get back to the moment where the markets had still trust and confidence in that particular economic bloc or country. So typically, those tipping points are something that are best avoided. Otherwise, sometimes the currencies or markets could keep going and difficult to calm down. I mean, you could look at, for instance, in recent throughout history, in fact, you could look at examples where eventually countries had to default on their debt, and the value of those currencies were just plummeting, right? In this is not something that happens every day. But if you look at back at hundreds of years, yes, defaults are not that rare, right? They do occur. So as a country, if you want to keep interest rates reasonable, you want to keep an eye on these things because otherwise the interest rates, once the markets don't think you have a credit-worthy basically situation, they are going to not, demand is going to be less for their debt. It's going to be difficult to repay that. Interest rates will have to go higher to make it more attractive for investors. Greece, of course, is also a recent example where investors were not interested in buying that debt because the debt was so high. So there are many ways how the currencies are impacted. As I already said, here's an example of when the economy is going up or when there's a big deficit. We kind of already talked about it here. It could lead to currency strength or currency weakness. So these are important aspects to understand, and based on the trends that we see in these countries, we already have an idea what could happen with the long-term perspective of that currency. Ultimately, it is basically looking at GDP and the debt. How big is the size of what is the size of the economy, and how much debt does that economy have? And the money supply and interest rates. And if you basically look at the reward to risk ratio at the bottom, it's basically all about what kind of interest rate is that currency offering? What kind of market returns could there be basically gained in that country? So you might say, okay, the dollar has a good interest rate. I will buy dollars because of that and invest it in CFDs because I think this, Google or Facebook will also go up. So you have the expected appreciation of the currency and potentially the dividends and or the market price rise. So that is the reward. The risk is what is the default chance and what is that balance between how would the GDP versus money supply work out? Will GDP grow? Then that's good. If GDP is stable but money supply grows, that's less good for that currency. That's the risk of holding a currency. And of course, this is not something that traders typically are looking for. Traders are looking to often capitalize on smaller price swings. But this is not necessarily unimportant for us either, because it still gives us an idea about the long-term perspective of one currency versus the long-term perspective of another currency, so that we can see what the long-term kind of trend is. That's still good info to know, even though we might not be trading or using that. But as long as we can see in the background what might be pushing a certain currency pair, which is the relationship, of course, between one currency and another, that is still very useful info for traders. All right, so as I already hinted in the currency pair example, ultimately it is all about the relationship between these currencies. So if, for instance, we think that the euro is looking good, but we think that the euro fundamentals are looking strong, that doesn't necessarily mean that the euro dollar is going up, because maybe the US fundamentals look even stronger. It's all relative. Whereas we might think that Aussie and New Zealand fundamentals look weak. I'm just giving an example, but one of the two might still be weaker than the other, and therefore the odd New Zealand might still go down or up based on which one is stronger. So it's all about relativity, right? But euro and dollar might both go up against both the odd and New Zealand, right? So it's all about the relativity between these currencies. At this moment, there is a lot of impact from the central banks. There is a lot of relative debt in the West, at least. So it is, you see, I think at this moment, not, you see, for instance, euro New Zealand, pound New Zealand, euro odd, pound odd, they are quite in the middle of a range. I think it is at this moment not a very kind of strong divergence between those. So I'm not seeing a very big fundamental move at this moment. I do think that the euro dollar is gaining traction to the upside. We've seen the price move from 105 all the way to above 120, for instance. So, dollar strength doesn't look as strong. The interest rate is not growing maybe as fast as expected a year ago or two. So my point is that there were definitely some big trends in the last 15 years. I don't think there are that many this point, I think the euro dollar is maybe one of them, but we also still see a mixed picture on the dollar because AUD USD is moving lower, for instance. So at this moment, not a ton of trends maybe from a long-term perspective, but keep in mind that that could change. We'll be analyzing it, that depending on how these countries evolve with these factors mentioned, that could change. All right. And I think that Nana will be taking a look at more charts. So I think it's best to leave it up to him with regard to that. But these factors are, of course, the basic factors. Well, at least it gives you kind of an idea how you can analyze the countries and how they're doing relatively to each other in terms of monetary and fiscal policy, and maybe get a bit of a sentiment at least what the long-term picture is. And then what we do at least is then look at technicals and see is there confirmation of that direction. And of course, when analyzing these long-term things, there are a lot of trading opportunities that we trade on a daily basis or inter-week basis that, from my point of view, are not really that tied to this particular analysis. But of course, if you're looking at the overall trend, it's long-term trend, weekly, monthly charts is still very good to keep this kind of analysis in mind. And of course, also keep in mind that news data on a daily basis does have impact because that's where you get these kind of confirmations or corrections as the market tries to gauge whether their sentiment for that particular currency is indeed being confirmed or not, as new data is being released and new measurement points are being offered. All right, so that's just a quick background on this. And now Nanette will, I think, take a look a bit at fundamentals and also at some charts. All right, let's pass it over to Nanette.
Thank you, Chris. Well, as you can see, Chris already gave you some great fundamental knowledge about monetary fiscal policy, quantitative easing, and now I will also give you my own opinion also about monetary policy. I will show you some charts and how basically that kind of policy can have an impact on the Forex and financial markets. Now, the thing with the monetary policy is that I know that most of you are not economists, so it might be maybe a little confusing for you, but I will try to speak as simple as I can, and we'll try to simply signal what can what impact can it have on currency pairs, especially dollar, yen, euro, and the GBP. Well, first of all, let me tell you that the main object of the monetary policy is to control the supply of money that is circulating in the economy, okay? So basically, monetary policies, as Chris already said, all these policies are implemented by central banks. And, you know, central banks, by its primary definition, should be independent, right? Is the primary definition of the central bank to be independent. But usually we know that it's not a fact, right? They're not independent, that is. They can make some decisions on their own, but of course that government guys influence all their decisions. Not just government, but also big business, huge market players, and people who are usually not seen publicly, right? So there is a lot of going on with central banks and governments, so they're not independent. And whatever I'm talking today, you know, this is my own opinion. You need to know that. So, well, my own opinion is, of course, that they are not independent because they need to work, and they work also with the government. Okay, so usually there is three ways that policy is controlled. So money supply is controlled in three ways. It's called RRR, it's required reserve ratio. Then there are open market operations and the interest rate. All in all, the interest rate is extremely important. Why? Because the interest rate, it is charging regular banks for borrowing money. And usually a hike on the interest rate is positive for a currency, while a cut on the interest rate is seen as negative. RRR is basically the percentage of, let's say, customer deposits that are used by regular banks, okay, to park in the central bank, okay? So all these deposits that regular banks use, they actually transfer it to central bank, and that percentage is called RRR. And the open market operations is basically the basic definition. All in all, it is the buying or selling of government or corporate debt. Okay, so that is basically open market operations. Now, of course, it's not that simple, because every monetary policy decision is not made by one member or the, let's say, chief of the central bank. Usually there is a committee behind all that, and they do their decision mutually. For example, in the UK, it's called the MPC. Okay, also it's yeah, before I move to this forward guidance, I need to say that there are two types basically of monetary policies that you should be aware of. It's so-called expansionary monetary policy and contractionary monetary policy. In expansionary monetary policy, central banks usually increase economic activity by lowering their interest rates and RRR, and it's called buying safe, high-rated debts. So theoretically, more money should be flowing to regular banks, and it will create more businesses lending and household spending, right? While in contractionary policy, central banks usually drop the money supply by raising interest rates and RRR, and they usually sell their debts, okay? So borrowing is not a part for contractionary monetary policy, because they are limited in their economic activity then. And definitely it's important to mention that forward guidance, okay? Forward guidance is the act of sharing their future plans in an attempt to influence spending decisions of households and businesses in order to reduce speculations on their next meeting. And usually when forward guidance plan has elected to public, then is when we see that currencies are moving higher or lower. And you should always, guys, pay attention to conferences after, let's say, latest rate announcement has been exposed publicly, because during pressers are so-called press conferences, price tends to move a lot. It's because the investors are actually reading between the lines, and investors, big players and big traders, they want to figure out themselves what a next step will be. So think about this. Central bankers, okay, such as BOE, ECB, BOJ, Fed, they use forward guidance between themselves. But when press conference is going on, and when they expose some things that they have agreed upon on publicly, that is the time when price starts to move. So watch for press conferences. Usually interest rate decisions are priced in the market, but pressers cannot be priced in the market. That is why during press conferences you will see that price is going up and down in a crazy manner. you need to be very, very, very careful, okay? Also now, what I will talk about is so-called fiscal policy. Fiscal policy is regulated directly from the government, okay? And there are a couple of ways that they can get their money from and influence different economic activities. First of all, it's taxes. We all know what the tax is, right? We are paying taxes, right? And government spending. Government spending is basically the infrastructure spending and, let's say, debt market activities. For example, buying, selling treasury bills and bonds. And have in mind that government spending directly affects the GDP, okay? It affects it directly. Now, it's very important that you know that taxes can curb inflation. And now the question is, how do taxes can curb inflation? Basically, they decrease the amount of money which people spend on without having a large impact on their power to spend. Now, it would make sense that taxes can decrease inflation rates, right? Since inflation is caused by too much flow of money. But instead, the extra currency is put back in government banks for later use. And this controls the monetary value of currency and their distribution at the same time, right? So despite indication of supply shortage, inflation is not that big of a problem unless it severely limits people's spending or nations' spending power, okay? And you need to know, guys, that the inflation is inevitable because the economy isn't fixed. A healthy inflation of prices will set the quality, guys, on certain goods, right? So the higher inflation of prices, it will set a possible quality on certain goods, but it will also keep cash flow in moderate rates at the same time, because a rise in prices indicates the overall progress in the economy. That is important to know. It's very important to know. Stronger pace of inflation is positive for the currency, but I'm talking about gradual pace, not a hyperinflation. Believe me, guys, in my opinion, as I have a master's in economy and I have witnessed a lot of things in my life, really, I think that there is no something worse than a hyperinflation. Okay, hyperinflation for me is the worst, even worse than severe price deflation, because investors will not place their money that in something that lowers the price. Okay, and hyperinflation is a total degradation of economy's currency. Simply said, during hyperinflation, the cash is literally useless. Okay? So the key to a good economy is to find a balance between inflation and deflation or prices. And they need to know what to do in a given time frame when things get out of the hand. So it's very, very important. Okay, the main cause for a higher inflation is the growth of the money supply without an equal growth in the country assets. When this happens, inflation will get higher. But it's very important to know that when you watch as traders the calendar, CPI and PPI actually measure the inflation. And these are the most important gauges of the inflation rate. Okay? So you also need to think about ISM index, and everything here, CPI, PPI, and ISM, have the impact on inflation. Okay, it's very important because you are traders. You need to be paying attention to this data. Okay. Now, the thing is that it's not just inflation. There is something called quantitative easing. Okay. Now, I took this from Wikipedia because this is standard definition, and I have my own definition. So, standard definition of quantitative easing is an unconventional monetary policy in which a central bank purchases government securities or other securities from the market in order to lower interest rates and increase the money supply. My own definition, guys, is quantitative easing is when government bonds are bought, so there is more cash in the economic system to facilitate further private lending and investments to stimulate economic activity. I think that, well, maybe my definition is a little bit easier to understand because, well, in the standard definition, there is no government bonds, and quantitative easing is when government bonds are bought. Okay, so basically, it's a massive expansion of the open market operations of a central bank, and the main thing with the quantitative easing is it's used to stimulate the economy by making it easier for businesses to borrow money. The bank, okay, buys government bonds and securities from its member banks to add liquidity to capital markets. And the effect is the same as increasing the money supply. But in return, the central bank issues credit to the bank's reserve to buy the securities. Now, you might wonder, where do these central banks get a credit to purchase all these assets? Well, let me tell you, they simply create it out of thin air. Okay? Why do you think that cash, the money, has any value? Because people create it. It's complex now to explain, guys. Look at this Bitcoin. Why do you think that Bitcoin has such a big value? Because people are adding it to its value. It's same as money. People are adding to its value. And the money can be printed out of thin air. While, let's say, Bitcoin cannot be printed out of thin air because at the end, I think of the 20, I don't know now, but I know that it's a limited supply. It's like you're digging something from a mine. There is a Bitcoin mine and you are diggers. I mean, understand that point. You cannot have unlimited Bitcoins as your assets. There is a limit. In money, there is no limit. Okay? They simply can print out the money, and central banks have the power to print the money out of thin air. And that is what we are referring to when we talk about printing money, right? By increasing the money supply, quantitative easing keeps the value of country's currency low. And this is why euro dropped, okay? This is the chart I am showing you. And this is the quantitative easing and the euro. When quantitative easing has been announced, watch what happened with euro. In 2014, watch this. Straight down, okay? Almost to the parity. So that is why I'm saying quantitative easing simply reduces money supply, okay? And actually, I mean, it can increase the money supply, but because it's increasing money supply, the economy's currency is losing its strength, okay? And watch how euro lost versus dollar when quantitative easing has started. When quantitative easing is stopped, usually a currency spikes, and you should watch, of course, always major crosses: euro versus yen, euro versus dollar, and euro versus GBP, right? Now, this is what happened when the UK inflation of 3% has been announced. Usually, a higher inflation, let's say, can be positive for the currency. I'm not talking about uncontrolled inflation, hyperinflation, but a gradual increase, okay, it can be positive, okay, for the market. But when you are trading during such strong news, you need to know that usually this data is already calculated in the market. It's already priced in. So usually there are some comments regarding latest inflation report and regarding future monetary policies. So it's very important to watch for press conferences or statements such as, for example, this is the example of BOE comments just after the inflation has been announced. That is positive. You see the price spiked here. Usually comments from the chief central bank, chiefs of central bank, usually they can tank the currency easily. And watch how GBP dropped after Mr. Carney comments, actually after the inflation. His speech, just his speech solely tanked the GBP versus dollar. And I said inflation is inevitable. It's always good, but a healthy inflation, not hyperinflation. Here, this is the example of US inflation. When inflation is lower than expected, watch this what happened when the CPI has been announced. In the expectation of lower inflation, US is tanking. And usually lower inflation than expected, watch the dollar yen, guys. Dollar yen is the best currency to watch in this case because it has a yen. Yen is a reserve safe haven, and the dollar is the main safe haven asset, right? And usually when inflation does not meet the expectations, well, dollar will drop versus yen. And finally, watch what happened. This happened yesterday when the CPI was announced. It was basically the same as market expectations. And watch what happened. There was a sort of almost a master candle here, support, resistance. When this resistance broke, bang, the price went up. So it's just the news, guys. The overall trend, you see it's going down. But just the news, it spiked the price towards my EMA 89. But watch what happened. Spike in price because the inflation report came exactly as expected. So always watch for CPI, PPI, ISM. It's very important for the inflation. And I hope that this webinar actually lightened out how monetary policy can actually can have an impact on Forex market. This webinar is being recorded, so you will be able, of course, to watch it again. I wish you a great trading rest of the week. Tomorrow we will come with new setups. I hope that you are trading this in the way as Chris and I have been teaching you. So we wish you a great evening and a great day of trading ahead, and talk to you soon, guys. Cheers. As always, trade safe.